Jonathan, I'm going to start with you. 2 days ago, did you actually think that the American and Chinese would be using the word truce? I mean, 3 months ago, Chinese and the Americans were not able to see each other eye to eye, and now they're saying hello to each other. How interesting is that?
Look, I think we all know at the end of the day the deal had to be done. I think one of the most frustrating things was the fact that it was always prolonged, and that portrayed in how a lot of the equity, how a lot of the commodity prices went. But at the end of the day, we've got two of the largest economies. The deal has to be done because the tariffs at the end of the day will help consumers and will certainly help hurt demand. So I think a deal is, but I actually think that this will only be phase one of many deals that will go on. But it's a sure sign that will hopefully shore up some of the commodity prices.
And we have seen that even that kind of hint of a progress has sent, the global markets spiraling up. Do you think then that this is likely to remain a trend, Jonathan, for the US markets, given that now we have some sort of certainty on this front as to what way the deal may go, that now, that opens the door for further upside for the US markets?
Well, I think the US equity markets, I sort of have a problem at these levels. I guess when I focus more on the commodity markets, I think it's a very bright sector. I think trade and demand, and and as one of your commentators said earlier, the inventory levels on a lot of these commodities are very low. But I think at the end of the day, US equity markets, I'm always nervous at these levels. We're at record highs. We're not moving on. We're just stagnant here at the moment. Will a positive trade outcome see prices go higher? I'm a little bit nervous of equities and have been for some while. Opt-in, obviously, for the commodity sector is something which I sort of spend and want to focus more on coming into next year.
Let's get you in on this then. Which way do you feel we're headed with all the kind of developments we've seen, this week, of course, for the overall context, but given that we've anyway been at the lower end of that cycle, do you feel now we're going to see something different?
Sorry, I was a little bit distracted just looking at the charts. I was just following on from my dear friend Jonathan. If you're looking at, as far as, and a couple of things on that, I'll just point to, that sell-off as far as the US dollar index over the last matter of, hours has been quite interesting. But the other side, of course, is that we haven't seen a market in the sense of what the S&P 500's achieved for many, many years. I don't think I've ever seen a market rise as quickly as what we've seen in the last 12 months. From 2,300 up to 31 and 50, it's been dramatic. So yes, as Jonathan mentioned, the value of the commodities have not been in lockstep with the equity markets. And I feel as though from an investment standpoint, there's so much more upside for a reintroduction or a kickstart of the bull market. I don't think it ever went away on holidays. It's still relatively cheap in pricing. And I feel as though that 2020 could be a very, very good year, following on from the Brexit. Now we've got the absolute picture of what's happened, a resounding success for Boris Johnson. And the other side, of course, is going to be, if a deal's to be done this Sunday between President Trump and Xi, then naturally I think that's going to be the right catalyst to drive the market a lot stronger over the next 12 to 18 months.
Jonathan, industrial metal capex is low right now. Do you see any larger supply deficit coming in? If we do see a rebound, what do you see as the key factors for a rebound? Which you just to outline the factors on either side here.
And then you're looking at naturally supply. So over to you, Jonathan, please.
Yeah, no, that's okay. When you actually look at the inventories are very low. And I think that capex has been low for some time. And I do think that'll start to come back into the market. When you look at some of the projects which have been shelved over the last couple of years, there have been quite a few. And that's actually caused those inventory levels, particularly on the base metals, to get to these very, very low levels. So once you do get those trigger points, you will actually see a resounding bounce. Although we're still looking, still tracking, but when you look at how low inventory levels are, particularly on the copper, you can see that any form of positiveness coming to the fray, which we are forecasting, should see more of a squeeze. So, and also, I tend to agree with Peter as well. This rally we've had in some of the commodities, we've just had such a long break, but I think that bullish trend is certainly still in play. particularly there's some good opportunities out in that commodity space. There's no doubt about it.
Peter, let's get in your take, because we have seen, slow global growth, and that has been a culprit when it comes to suppressing metal prices. But the fiscal policies, the monetary policies around the world, they're getting fairly supportive, if you will. So how do you see metal prices in light of these policies shaping up then?
Well, the benefit to any producer has been the absolute cost of money, and it's at record lows globally. So it's a great time to put all of that capex spend in and borrow extensively for new opportunities, being in other countries or in your own resource based. If you were a copper producer or an iron ore, or if you're across nickel or lead or zinc, whatever your call is, then naturally you've got the potential to greatly appreciate the asset value of your particular commodity over the short to medium term. And this has been very, very demonstrated, as we've seen in recent years with the shale revolution and what the drillers have done there. A lot of the smart money looked at those particular opportunities. Now, naturally, we've seen a bit of a handbrake as far as crude prices, in the sense we haven't seen high upticks. Now the opportunity is for many miners to look at different other parts of their portfolio, the likes of BHP or Rio, and may see other opportunities in some of these base metals. There is no doubt, with not only from the demographics, but as far as population explosion, 2020 is going to be a boom, I think the start of a boom decade, really for the whole globe. And I don't see any handbrake attitude. You've got growing population growing at a couple of 100 million a year. Consumption patterns across the world are just shifting, and everyone wants a better quality of life, and that means more raw commodities.
Okay, gentlemen, so I'm going to throw a question. Anybody can take it, since you both are good friends. Next 5 years, if you have to bet on one asset class and you would say, I'm going to bet on this asset class, doesn't matter what the outcome of US presidential elections are, doesn't matter whether Chinese and Americans are talking or not, doesn't matter if there is problems, political problems in Brazil or problems in Vietnam, I'm going to stick my neck out and I'm going to buy that asset class for next 5 years, and I'm so confident that I would buy it on leverage. I've thrown this question up. Who wants to pick it up?
I think Peter and I will probably be on the same page on this one. I think, but when I look at it, I look at the base metals. They seem to be some of the most depressed ones. I think that to me is probably one of the greater opportunities, and also the precious metal sector. When I look at equities, I think they're too high. When I look at bonds, I think they've sort of had their day for some time. But I generally think 5 years is a long time. There's no doubt about it. But when I look at the start of where we're going, some of these commodities are at very low price. Some of those base metal prices are very low, and inventories are very low. So I'm looking for a good rally, particularly in the base metal sector.